bog standard bond has three attributes. It's got an issuer, an interest rate, and a payback date. Now I want to come back as the bond market because you can intimidate everybody.
And even the FTSE 100 has made a new high.
Cut taxes, I don't care about what borrowing's doing. The bond market said, we don't like this. I'm wondering whether we are now reaching the stage where it pays to take a few chips off the table. What else is there for the bulls to play with?
Netflix, which we all know and love, were expected to do very well because of Squid Games. They did. They had great results. But the shares actually managed to fall about 5% on the back of it.
Just if we do need to clarify to Chris, so Netflix is this great online thing where you can watch movies without loading a DVD in. Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to episode 3 of The Art of Investing, the Bond Special, brought to you by IG, the global investing platform. My name is Rich McDonald and I'm joined today by Chris CJ Fellingham and Mark Spice Holden. Today, we're bringing you all you need to know about bonds and I can't wait for this one. Before we get into that, we're going to take a look at what's been happening in the markets this week. Spice, what is driving us higher?
Well, hi, everyone. Well, as a natural optimist, being an equity investor compared to the bonds, as you'll hear, they're natural pessimists. It's been a really exciting week in markets again. We've made new all-time highs in the S&P 500, NASDAQ, and even the FTSE 100 has made a new high, which is a rarity, I know, but it's pushing up to new highs along with copper. And that's one of the things that's helping the FTSE because the FTSE has a lot of mining companies in it that make a lot of copper and they're natural beneficiaries of that. The rest of the markets around the world have lagged a little, although they were given a boost, particularly in Japan and Asia. Japan have managed to eke out a deal from Trump of 15% tariffs, which is better than the people were expecting.
After 8 trips by the Japanese to Washington.
It shows face-to-face negotiations are better because the Europeans still haven't got there. But the Japanese stock market, the main stock market in Japan, the Nikkei, rose 5% on the back of it. It's very, very close, within a whisker, 0.5% of its all-time high. And Europe were given a little boost themselves because the FT ran with the story that they are about to do a similar deal with Trump on the tariff side.
I thought it was particularly interesting that the autos got carved out. They got saved. So I think Nissan was up 7%. And of course, then there was the read-through to the German autos as well. Maybe they'll be part of the trade deal and not get quite as big tariffs. So they were up 6% yesterday.
Absolutely. Helped the DAX have a nearly 2% day. Which again is very good, taking them again within about 0.5% of the new all-time high in Europe. Other European sort of countries not doing as well, but DAX, the Germans are leading it, which is good to see. So all that is very positive in the background. We're just waiting now to see whether South Korea can sort of come out with a deal. There are lots of other countries involved trying to do deals, but the ones that are important for markets, we've just had the big ones, which is Japan. And as long as Europe get that over the line, that will be important for overall sentiment. We're also in the middle of the second quarter reporting season. You pick up the paper, you look at the news channels, and you'll see that there's a whole wave of companies coming through. We talked last week about beating expectations and expectations management from markets. And Netflix, which we all know and love, were expected to do very well. So the expectations were high because of Squid Games. The last part of Squid Games was coming through. And they did. They had great results, better than expected. But the shares actually managed to fall about 5% on the back of it because expectations were just got a little bit ahead of themselves. General Motors, on the other side, were one of the first companies to quantify how much the tariffs are going to cost. And they're estimating that's going to cost them as a company $1.1 billion next year, which is a huge amount of money. The shares fell 3% as a result. But at least they had a go at telling the markets what they thought happen.
Just if we do need to clarify to Chris, so Netflix is this great online thing where you can watch movies without loading a DVD in.
Even I have started to use Netflix. A bit of a Luddite, I certainly am, but Netflix is there. Amazon Prime as well, I've heard of and am using, but I've gone about as far as I can.
One thing you will remember, though, is Nokia. Do you remember those?
Oh, I love my Nokia phone. My Nokia phone was fantastic. It's like having a brick in my pocket.
Exactly. Well, the old brick company, Nokia, which interestingly came out of tire making, if I seem to remember rightly, basically, back in the year 2000, was the biggest company in Europe. And, they've gone from bad to worse. And the shares have now fallen 87% in the last 25 years. Having been Europe's biggest company, it's now a company we don't even bother about. But they had a profit warning, just another one. They've had loads over the last 25 years. The shares fell 15%. So very bad expectation management on their part. So talking about the companies in the Magnificent Seven, and Netflix is just outside of that. If you remember the Magnificent Seven, sometimes called the Mammutams, which is basically Microsoft, Apple, Meta, Alphabet, which is Google, of course, to most of us, Tesla, Amazon, and NVIDIA. Those are the Magnificent Seven. And yesterday, so for your listeners, that was on Wednesday, Tesla had results. Again, didn't live up to expectations. They were expected to be poor, but they were even worse than expected. And Elon Musk didn't do a great deal to support the share price. The shares fell 6%. And on the other side, Alphabet, or Google, as we all know it as, actually had great results. And the shares have risen 3.5%. And that was despite them saying they're going to significantly add to their AI investment. And that's really important because that then helped all the other AI companies like NVIDIA, the world's biggest company. NVIDIA are up about 1% today as we talk. But Google shares, Alphabet shares went up 3.5% as a result. So a good start to the Magnificent Seven reporting season. Next week, we get another 4 of them, all the rest except for NVIDIA, and NVIDIA report at the end of August. So they're really important because if you look at the underlying earnings expectations within the S&P 500 for this quarter, well, the Magnificent Seven are expected to deliver about 14% earnings growth, and the rest of the market underlying is expected to do only about 3%. So it's really important for the overall market that these companies deliver. And so far, one of the 7 has delivered well, and one of the 7 has delivered badly.
And we check them off one by one. And is that part of your famous wall of worry that we've been climbing, Chris?
People have always and will always worry about the numbers that are coming through. But as we talked about, as Mark's mentioned already, we covered it pretty well last week, the companies generally are pretty good at massaging the expectations to where they can still beat them. I'm never surprised when a US equity comes in and beats numbers, because that's why they trade on 29 times historic earnings. If they don't hit it, they've got real problems. Over the last few weeks, we've made it pretty clear, I think, opposed to one member of this team who was brandishing yellow cards last week for us being bullish. We made it pretty clear that bull markets climb a wall of worry. And I personally am of the view that we are now getting to that stage where I'm worrying about where the bad news is, because at the moment, everything that I was worrying about is now out in the open. The thing that I was really thinking about, which the wall of worry was going to climb, was the tariff announcements.
Yeah.
And for them to come out and say, Japan's got a deal, and then to come out and say, and Europe's probably got a deal as well, and the market to not say, oh, I don't know whether it has or it hasn't, but to price in immediately it has got a deal, I'm wondering, what else is there for the bulls to play with? Now, clearly the earnings are good. That's great, and that's superb. But as a sort of macro investor, as a bigger picture investor, I'm sort of wondering whether we are now reaching the stage where it pays to take a few chips off the table. And one of the things we'll be discussing over the next couple of weeks when we look at our portfolio construction is, what should our equity weighting be? And there's going to be quite a big debate, because I'm giving you one side. I'm sure Mark will be giving us the other side, and we'll have to somehow work out between us how we're going to put that together with your input, clearly, Rich, from a clearly negative person to start with.
Negative person. Cautious, let's go with. But I can see where that argument has come from, CJ, and hands up, I will yellow card myself with my bearishness. However, what are you now feeling at this point? What would you be doing?
I've been fully invested in equities. I've actually had a lot of equities and basically nothing else, as Mark knows. And I've started selling my UK equities today. I've sold out most of my US equities already because into Europe and other things. So I don't like the dollar. Nothing to do with the US equity market. US equities are fine. I just don't like the dollar. But I've got big overweight positions in the UK and in Europe. I've started to lighten the load because I think we've got to the stage where all the good news is priced in.
Is he too early, Mark?
Well, I might disagree, and we haven't really got time to discuss that here because there are lots of good reasons. We will cover it in the future. But all I'll say is, remember, a profit is never a profit until it's sold. Basically, if you've made a profit, bank it. That's a profit. If you don't do it, it's never a profit.
Perfect. Right. Well, that gives you the perfect example of the kind of debates that are be going on in the coming weeks. Because remember, the difference with this podcast is that the guys are going to be launching a model portfolio. Along with IG, you're going to have a live portfolio running, and there's going to be live debates like we've just got a snapshot of as the weeks go by, which I am very intrigued to hear, knowing that now you're almost at odds.
We're becoming on the other each side of the debate.
On equities.
Bring
especially.
it on.
However, today, of course, is all about bonds, also known as fixed income. Professor Bond, lead us into our lecture.
To start with, when we talk about fixed income, some people might call it fixed interest, or you'll hear the name bonds, it's all the same thing. So first thing is, don't get confused by the terminology. They're all bonds, and that's what we shall call them in today's little briefing. They're extremely important in the financial markets because they tell you at what rate governments and companies can borrow money, what the key interest rates are in the marketplace.
And I guess it feeds through to mortgages as well.
They feed through to mortgages, they feed through to valuation of equities, what's the risk-free rate, and dividend growth rates on top, all these sorts of things. They are fundamental to how the markets are all valued. Bond markets do well when everyone else is suffering, and bond markets do badly when everyone else is doing well. And you'll see that when we get through and talk about some of these things. So I'm naturally always looking for slowing economies, low inflation, deflation. I'm looking for the pain because I know that's when bonds will do well.
From Finance 101, we're always looking for things that behave in different ways, aren't we? Because then the correlation in portfolios, i.e. how not to lose money, how to reduce your risk overall, that really helps when things perform better at different times.
You're getting really into the weeds of portfolio construction when you mention things like diversification. Because as you say, a perfectly formed portfolio will have a number of assets in it which move in different ways and therefore provide some diversification if something goes wrong in what you think is going to happen. We'll be talking more about that when we come to the portfolio. Let's stick with what we're talking about here on bonds first, but they are diversifier away from equities, and so they need to be considered, and we need to think about them. They're somewhat complicated, but don't let that put people off. They have the power to destroy the best laid plans. Look at Liz Truss and Donald Trump, a pair you would never normally put together. But Liz Truss ignored the bond market. She came in, the mini budget, cut taxes, I don't care about what borrowing's doing. The bond market said, we don't like this, sold off. Chancellor had to go, and then Liz Truss had to go. And then, of course, with Donald comes along with his super tariffs. Everyone's going to pay me lots of money, and China's going to pay me 20, 40, 60, 100, 150%. Bond market starts selling off. Bond yields are going up. It's going to cost the US government to have to borrow at these levels. Suddenly, it's all sweetness and light. And now it's much more realistic and much nicer. So both times the bond market had big influences. And there's a very famous quote. And so here's the first thing for everybody to remember, the famous quote from a strategist of Bill Clinton, a chap called James Carville, who said, I used to think if there was reincarnation, I wanted to come back as the president or as a 0.4 baseball hitter. Now, for those who don't understand baseball, just a quick side note, 0.4 means they hit the ball 4 times out of 10. So if you do that, you're genuinely a really good baseball player. Don't know anything about it. Please don't send any comments to me. So he said, I want to come back as a president or as a 0.4 baseball hitter, but now I want to come back as the bond market because you can intimidate everybody. That is what happens at those extremes. The bond market intimidates. Okay, so let's talk about bonds themselves. They come in all shapes and sizes. We have asset-backed bonds. We have index-linked bonds. We have infrastructure bonds. We have zero coupon bonds. We have so many bonds that it gets confusing even for me. So we're not going to go anywhere near that. We're going to think of a bog standard bond. And bog standard bond has 3 attributes. It's got an issuer, an interest rate, and a payback date. The issuer can be a government or a corporate entity. It could be IG. It could be the Japanese government. The interest rate is the amount the issuer will pay you each year. So each year, you give them some money, they give you some money back. That's the interest rate they pay you. Payback date, or what's not known really is as the redemption date, is when the issuer agrees to give you the face value back of your bond. So 3 bits: issuer, interest rate, payback date. Let's take an example close to Rich's heart.
No, I can't wait to hear what this is.
The Thames Water 6 3/4 2030 bond. Do you want to just give a 30-second as to why you know this bond?
Oh, I'll keep it to 3 seconds. It cost me money.
Because it went down in value and you sold it?
It was one of my ideas about diversifying my portfolio away from equities, and in a list of 10 corporate bonds that I held, including Heathrow Airport, John Lewis, Thames Water was one of them.
So if we take that example of Thames Water, 6 3/4 2030.
It's underwater.
Thames Water, thank you. Thames Water is the issuer, 6 3/4% is the interest rate, and 2030 is the redemption date.
And I get the interest rate every year.
Every year you get the interest rate. So think of a bond as an IOU, essentially.
Is this where the term "my word is my bond" comes from?
No, the word is my bond was the old city saying for, if I tell you I'm going to do something, I'm going to do it. If I said I was going to buy it here, I'll buy it. If I said I was going to sell it here, I'll sell it. And you could not break that. In the city of old, there was nothing worse than breaking a commitment like that. One other thing that's important with a company bond, with a corporate bond, is it comes before equity in the capital structure of the company. So if the company goes bust and they're sharing out the assets of the company, the first dibsies go to the bondholders.
Is not the inland revenue.
The inland revenue sits there as well, but we don't want to overly complicate things. The bond guys come before the equity guys.
So you'll get paid before Spice does.
Correct. Now.
Same old, same old.
Yep. Yeah. Now, the interesting thing there is that the bond is therefore thought of as more low risk than equity because you're slightly better off in the capital structure, but you can't get any more capital gain on your bond than getting back 100 at the end of the day, getting back the face value of your bond.
So the maximum I can receive in return is how much I lent you and the interest rate per year.
And so you're capped as to how much you can get. But you are actually taking a lot of that equity risk, which is why, as Mark knows, over my career, I have brought about this expression. I cruelly like to think of corporate bonds as equity without the upside. So I'm taking the equity risk, but I've got no upside from it because I'm just getting a fixed yield. So if I'm happy with the equity and they're not massively overvalued, why wouldn't I buy the equity? So in my personal portfolios, there is very little exposed to corporate bonds. That's a particular part of the bond market.
Okay, so what can we take away from that X-way? What's the really important couple of things to take away from that?
First things to take away are who's issued the bond. So when you see a bond, wherever it is, lying around on the floor, in the FT, wherever, who's issued it? What coupon are they paying? When's it going to be redeemed? That's what you need to understand about a bond. You've understood where it is in the capital structure because we've just talked about that. And then the final point I want to make before we go to the 2 key rules that we need to learn and understand about bonds is the price a bond trades at reflects what the current interest rate is in the country or in the economy, Where people think that's heading, so whether you go back to Mark's talk about expectations on equities, this is the expectations on where interest rates will be going. And it will also reflect the credit risk of the issuer. Because if I have a bond that's 30 years to redemption and it's in, I don't know, Marks and Spencer's, or if I have it 30 years to redemption in the UK Treasury, I'm going to think the UK Treasury is a far better credit risk than Marks and Spencer's. Now, we can debate that by all means, but the government has the power to tax. The first thing to understand about bonds is when prices rise, yields fall. When prices fall, yields rise. Now, I'm going to give you a little example of how that works. Let's assume base rates are at 10%. And I have a bond which yields 10%. Okay, happy with either? That's great.
Okay, so bond 10%, interest rates 10%.
Correct. If interest rates fall to 5%, then people are going to look at my 10% yielding bond and say, gosh, that's valuable. I'd like to buy some of those. The price, therefore, goes up as the demand for that bond increases.
Because you'll get 10% back per year with this thing.
Yep.
And you now only get 5% with this.
Correct. So prices will rise because yields will fall. Because by definition, that 10%, it will still be valued at 9%, will still be valuable at 8%, will still be valued at 7%. So the price will go up until it gets to a price where people are not caring which one they buy. So prices go up as yields fall.
The way I got my head round this back in the good old Credit Suisse graduate scheme, which was across in New York. We got flown out to New York for 10 weeks. But I sat there and I tried to understand, but not until the teacher said it's like a seesaw. Imagine a seesaw where you've got coupons, yields, interest rates on one end, and the price of the bond on the other. And they go up and they go down.
Yeah.
So as the yield goes higher, the price goes lower. And as the yields go lower, the price goes higher.
Sometimes it's not as intuitive as people think and talk about these things. But if people are talking about prices going up, yields are falling. And if prices are going down, yields are rising. Get that, everybody get that into your minds. Because when we talk about our portfolio, we'll talk about where we think interest rates are going, where we think yields are going to go. And that will then dictate whether we think prices are going up or prices are going down.
And by the way, the principle is exactly the same in equities. So, if the yield goes up, the price has effectively gone down.
I think the second important thing to understand about bonds is that shorter dated bonds, and I'm going to say, when I define short dated bonds, I'm going to say less than 5 years to maturity. So something with 1 year to maturity, 2 years, 3 year, 4 year, 5 maturity, they are dominated, where they trade is dominated by where you think interest rates are going to go. So if you think interest rates are going to go down for 1 year and up for the next year and down for 1 year, that will affect that short-dated bond quite a lot, because buying that short-dated bond, a 3-year bond or a 4-year bond, it's so close to today, you can sort of imagine where you think interest rates are going to be. So you can have a really good, very good, accurate thought of whether that's value or not.
So if I just need to borrow money for 2 years, I'm considered a short-dated bond.
If you're borrowing it and you issued the Rich McDonald 2-year bonds, that would be a short bond. I also don't think it would be very creditworthy, but that's another subject. So then, longer dated bonds are those with 20 to 30 years to go to maturity. So they're long time out. You've got to you've got to think really hard about what the value of a 20 to 30 year bond should be, because they're dominated not just by the outlook for interest rates in the short term, where interest is going up or down. They're dominated by supply and demand, the budget deficits of countries, how much is being issued, and also the creditworthiness of the borrower. I can perfectly sit here and say, let's pick John Lewis, as you've mentioned it already. For 2 years, I think John Lewis is a good credit. How do I know they are in 10 years? How do I know they are in 20 years? How do I know they are in 30 years? And my uncertainty gets worse as I get longer, so I want a high yield. And the point I'm trying to make here is that because there are so many other things which are influencing the longer dated bonds, they will yield more. If there's more risk, you just expect better return. They will yield more than short dated bonds. And you get, therefore, what's known in the trade as a yield curve.
I'd like to take a moment to make you aware of an awesome offer IG is currently running. Until the 15th of August, IG is giving away a free UK share bundle to all new customers worth up to £100 when you invest just £20. Sign up for a general investment account, a stocks and shares ISA, or a SIP and make your £20 investment to get started. Your capital is at risk. The value of your shares, ETFs, and ETCs can fall as well as rise, which could mean getting back less than you put in. New customers only. Offer is valid until the 15th of August for ISA, GIA, and SIP accounts. Other fees may apply, and T&Cs apply. So I guess the further you go out in time, the less you can predict things. If I've got 2-year goals, I'm pretty sure what those 2-year goals will be. 20-year goals, who knows?
Isn't it also fair to say that the central banks can control the short end much more than they can control the long end? So when markets get really scared, it tends to be the long end that has the biggest moves and has a big impact on things like equities, etc. Because the central banks can say, we're going to hold our nerve for the next 2 years, and markets sort of have to believe them. But they have no credibility when it comes to looking out 20 or 30 years.
I kind of feel we almost need a visual representation here of what this yield curve is, or the difference between a long end and a short term.
I think that would be a useful experiment. And we're going to try, therefore, for those of you who are watching on YouTube, a visual example of what we're talking about. On your left-hand side, as you look, is the short-dated bond, and that's Rich.
That's me.
So Rich, let's say Rich is a 2-year bond, and he's quite low.
Right, well, I'll get low.
And then on your right-hand side, you see someone who looks like a surfer, which is Mark, and Mark is the long-dated bond. So Mark is a 30-year bond. He's higher in yield, so lower in price, whereas Rich is lower in yield, and what they're holding between them is a yield curve of all the bonds in intervening maturities.
So 2, 5, 10, 20.
30 or longer.
There we go, guys. And if you enjoyed that, I don't really know what to say.
That's a surfing position I haven't used for about 40 years.
So what factors would you expect to affect longer dated bond prices? Because I think this is critical, and we'll have an example in a minute. The most important factor is, will you get your money back? If we take that example of Thames Water 6.75 2030 bond, they were issued at 100. They now priced at 68. They yield 16.75%. Given that is only a 5-year bond and it yields over 16% against interest rates around about 4 at the moment, you can tell there's a lot of doubt whether you're ever actually going to get any money back. There's a perfect example of the market doubting you're going to return a capital. Other factors, though, are inflation. High inflation means higher interest rates. Higher interest rates mean higher yields. Higher yields mean lower prices. So when we get inflation and we start to think inflation is a bit of a problem, don't go anywhere in the bond market. It's not going to be a good place to be.
So as the government tries to slow down the economy and take the heat out of it, then what would I expect that to do to bond prices?
When the market starts to see success, that it can now start to look forward to a time of lower interest rates, then the bond market will start to rally. But that's only a long way into that process, because you've got to get on top of the economy. You've got to slow it down. You've got to make inflation behave. And as we all know, we used to have an old expression, the economy is like a supertanker. Once you get it started, it's tough to stop. Once it's stopped, it's tough to get started. Right. And so once it's going, you've got to put interest rates up probably much higher than you think you will have to get in charge of inflation. So I can see that I'm about to get a yellow card from Rich. So we'll move on. Growth is another thing that influences bond prices. If growth is slowing, it means interest rates might be cut. If interest rates might be cut, yields will come down. If yields come down, prices go up. Supply and demand influences things, because the more supply, the lower the price, the higher yield. Okay, so all these things are there. And I'm going to give a quick example just to show how that all works. And the one I'm going to choose is the Liz Truss example that we talked about earlier. Government bonds are used to finance the gap between what the government gets in through taxes and what it spends on the other side. That number could be a small number. When Gordon Brown and Tony Blair was in, that actually went to surplus, but we haven't had a surplus since then.
Oh, those were the days.
And the budget gap at the stage of Liz Truss was £133 billion, which is 133 with 9 zeros behind it. The Chancellor cut income tax, corporation tax, national insurance, spent on heating cost subsidies, and had no care about budget increasing and didn't talk about any sort of way they were going to control spending or do any of that sort of stuff. They talked about they would do it. There was no evidence of it.
So their income was dropping.
So the income was falling, and what they're spending on wasn't showing any sign of falling. After the budget deficit was 177 billion, which was an increase of 44 billion just in that mini budget. And the worst news was the Chancellor that weekend, Kwasi Kwarteng, said in an interview on Laura Kuenssberg, we've only just started. We've got lots more ideas for tax cuts, lots more of these things to go.
So I'm guessing the market started worrying about the ability for the government to...
Well, come Monday morning, all anybody could see was it was raining gilts, and so lots of supply, worries about what's this going to do to the economy? Is it going to be inflationary? Are we going to have to tighten rates because growth's going to pick up with all these taxes being cut? Well, market sold off massively. Essentially, it forced the market not to work properly. The Bank of England had to come in. The Bank of England had to offer a facility to buy anybody's gilts if they wanted to sell them. That was the end of the Chancellor, and that was the end of Liz Truss.
So in summary, they almost ticked every single box that is bad for a long-dated bond.
Yeah, and we're not here to get in the politics of it because I think we'll all have views on it and we can talk about that another day. It was done badly. It was exactly what the market didn't need without any preparation. And the gilt market said, you know what? If you're going to borrow this much money, we're going to put yields up a huge amount, so it's going to cost you a lot of money, which means gilt portfolios collapsed in prices.
So to go back to my seesaw example, prices down, interest rates up, everybody's mortgage is up, and there was just panic, wasn't there?
Yeah. Bonds are a vital part of the financial machinery. They're less risky than equities, but they don't have the capacity to return as much. They're really useful to understand where the city thinks interest rates are going to in the future, and they will move well ahead of what the financial press is telling you will happen. Watch the bond market first. It will tell you what's going on, right? It's got a great ability to see what's going on before any economic commentator will tell you anything.
Right.
Before your Goldman Sachs's or your JP Morgans come out, they all follow the bond market. The bond market leads. And so watch the bond market. It's a real canary in the coal mine.
And by the way, equity investors watch the bond market just as much as other people do as well, because when you get sudden changes, equity guys aren't worried about it. But when you get sudden big changes like you had with the Liz Truss budget, then equity markets sold off as well. Everything sold off. The pound went down. International investors said, we don't want to invest in the UK. Whoa, we don't know what's going on there. And we don't trust them to give our money back.
God, this is all excellent stuff. And it feeds into the portfolio debate so well, because now I love equities. I always have. But I've become even more interested in bonds now that we've talked through. And I'm really happy that there's another option to put
a convert to the fixed income side.
There's one. There is one.
Yeah.
So this takes us perfectly into today's question. And an email that we got from a viewer of last week's podcast said, right, you've talked about launching this model portfolio, and it's going to have equities, it's going to have bonds in it. How are you going to decide what goes into it? What's the allocation going to look like? And how do you decide what instruments to use, for example?
First, let me give you a little bit about the timing of it. I feel very strongly, I know Mark agrees with me, that if we're going to go through a process of talking to people about what's in our portfolio, how it's going to change over time, how it's going to react to various things, we need to explain to people what the building blocks are. And these episodes, last one on equities, this one on bonds, next week it'll be on commodities, bit of gold, bit of Bitcoin, those sorts of things, are there to build those building blocks for people to see how these things move. So when we talk in the podcast afterwards, so not next week, the week after, we will be unveiling our portfolio and explaining why we've come to the decisions we've done. We'll talk about some of some of the debate that's happened, and we probably have some debate in there as well. But it will makes much more sense to people if we do that in that way.
But the exciting thing coming next week is a list of some of the instruments that you guys will be looking at, ones that you've used throughout your career, that you know that the funds that you've both worked with use, and we'll be showing those on screen for everybody to get a kind of taster of, right, how do I get access to these equities? How do I get access to the bonds? And you mentioned we're going to be talking about commodities, gold, even Bitcoin as well. So that's coming next week, and that's exciting to see what it's going to look like. But yeah, how are you going to decide on what to get in there?
I think one thing to say is we're not going to own direct equities because there's too much risk in just owning one stock. For example, if Elon Musk gets run over, the Tesla share price would sort of halve probably. And if you've got 10% of your portfolio in that, you're down a huge amount. You're down 5% in a day. So we're not going to do that. Is a way of investing. You could invest, but we're not going to do that. So we're going to be not single stocks, but we'll buy things like ETFs, exchange traded funds, which give you an exposure to an overall stock market like the S&P 500 or the FTSE 100, and exchange traded commodities as well, so that they basically gives you an exposure to lots of commodities as well without owning a block of gold, which obviously not everyone can go out and buy a block of gold. You can buy unit trusts or mutual funds, as they're called in America, where basically we could, you pay within that structure another manager to do the job, trying to track or beat a stock market or beat a different index, what you want them to do.
Oh, we don't need those.
We don't need managers. Exactly. And there are things like investment trusts. And ironically, those last two things, investment trusts and mutual funds, retail funds, are very expensive and not what we want to give you, the potential followers of this portfolio. Because in things like exchange traded funds, it's very, very competitive. So prices are tiny, anything from like 0.07% or 0.05% up to maybe 0.25%. Whereas you might pay a manager of a fund sort of anything up to 1.5%. And we don't want to do that because 9 times out of 10, I hate to say it, and having been one myself, they don't do what they're meant to do.
This week's yellow card is not for what you're saying, but I cannot believe how much you've been getting paid for the last 40 years as fund managers.
Been a hand-to-mouth existence, Rich. That's why I'm here looking as impoverished as I do.
Well, talking of which, I do have a flight to catch, gents. I am off to Ibiza straight from the podcast. So I think we're going to have to round up this week's. Otherwise, you don't want me missing my flight. It's been wonderful. And if you have enjoyed this week's episode, then remember there's a new episode every Friday. So make sure you hit that subscribe button. And what else should the viewers and listeners do?
Email in to the art of investing at ig.com. Any questions, observations, anything you like, we're ready and willing to answer most things.
And if you like it and tell other friends and people about it, that would be great too.
Thank you so much, everybody. And thank you for joining us again on The Art of Investing, brought to you by IG, the global investment platform, FTSE 250 listed and has been in markets for 50 years. Give us a like, give us a follow, and let your friends know if any of you have heard friends asking, I'd love to start investing, but I just don't know where to start. I find it too intimidating. Then these guys are the least intimidating two out there that you'll get. We'll see you next week.